Hi, my name is Christian Waldegrave, Head of Research at Teekay, and this is our conventional tanker market update for November 2017. Well, looking back at what happened to rates in October, it was a fairly strong month for tanker rates. In fact, on the Aframaxes, it was probably the best month we've seen since January, so a 9-month high. And I think that was due to a couple of reasons, some seasonal reasons and some structural. On the seasonal side, coming out of Q3 into Q4, we have that uptick in refinery throughput as refineries come out of maintenance and look to increase their throughput ahead of peak winter demand season. So that gave a natural lift to tanker demand coming out of Q3 into Q4. Also at the start of October, we had some weather issues in the US Gulf because of the hurricanes, and that caused some vessel delays and gave some support, especially to Aframax rates in the Atlantic Basin. There was also a couple of structural things that happened in October as well. Firstly, we saw very strong crude oil imports into Asia, especially into China, again, as those refineries ramped up their throughput. And a lot of that oil came from the Atlantic Basin, so we saw especially high volumes of US crude exports. In fact, at times, US crude exports were up at about 2 million barrels per day. A lot of that's due to the fact that US crude at the moment is fairly low price compared to other crudes. So for example, the spread between WTI and Brent is about $6 to $7 per barrel right now. So that's making US crude very attractive to refiners around the world, places like Europe, Latin America, but especially in Asia. So we've seen a lot of long-haul oil movements from the US Gulf to places like China and India. So that gave another boost to tanker rates during October. However, as we've moved into November, we have seen tanker rates started to drop down again. In fact, on some routes, we've seen rates go back below $10,000 a day, whereas in October they were in the kind of mid to high teens, and some routes were even above $20,000 per day. And I think that's just a reminder that we are coming out of a very low point in the tanker cycle, and it will take time before we see a true market recovery. And the reasons why we've had this weak tanker market in 2017 have been twofold. One, very high tanker fleet growth, and then secondly, OPEC supply cuts. And certainly the tanker fleet growth has had a big impact on the tanker markets in the last couple of years. If we look at the size of the tanker fleet now, it's about 11% larger than it was at the start of 2016. So that's a lot of ships for the market to absorb in a relatively short space of time. The good news is on the fleet growth side is that we can see that is starting to turn. We're now at or just past the peak of tanker deliveries. The order book rolls off as we go into 2018 and 2019. And we have seen an increase in tanker scrapping as well. We've had about 8 million deadweight of tankers scrapped so far this year. And that's quite a big increase on what we saw in 2015 and 2016, when we only saw about 2.5 million deadweight scrapped in each of those years. So as the order book starts to roll off, and as scrapping has picked up, then that fleet growth, which has been running at about 5 to 6% over the last couple of years, should fall to about 3% next year and as low as 2% in 2019. So that'll be very positive for the tanker market as the fleet growth comes off. So then that leaves us with what happens to tanker demand, and in particular what's going to happen with OPEC production. As we know, they're cutting production at the moment until March 2018, but they've made a lot of comments recently, or there have been some comments that they may look to extend those cuts out, possibly to the end of the year, to the end of 2018. But I think a few recent events might give them a chance to pause and rethink that, because what we've seen in recent weeks is that global oil inventories have really been trending down very rapidly. And as a consequence, global oil prices have been going up. And just recently we saw oil prices passing through $60 per barrel for Brent. In fact, it got as high as $64 per barrel the other day. And that's really a reflection of how strong oil demand is. And then the OPEC cuts on top of that are causing oil inventories to come down. And on top of that, what we're also seeing now is that there are certain parts of the world, certain countries, where we're starting to see some geopolitical issues raising their head. Places like Venezuela, Nigeria, Libya, Iran, Iraq. These are all quite major oil producers that are having some issues right now which could lead to oil disruptions. So if we're getting a tightening oil market with higher oil prices, and then we do get an oil disruption on top of that, I think that's going to tighten the market even more. And that might make OPEC rethink their strategy, because OPEC wants to rebalance the oil market, but they don't want to push oil prices up so high that it kills demand and that it encourages people like shale oil producers to produce even more, and then they lose market share. So I think what's going to happen is OPEC meets at the end of this month. They might just wait and see what happens between now and March. If the oil inventories continue to come down and oil prices continue to find support, they might find that they don't need to extend much further. And certainly our internal view here at Teekay is that we think at some point in 2018 that OPEC oil is going to be needed, because we think oil demand will stay strong, those oil inventories will continue to get drawn down, and OPEC is going to have to pick up the production in order to fill the gap. But again, that's probably going to come more in the second half of the year than the first half of the year. And that's why we think that in the next 6 months, we'll continue to see a difficult market somewhat. We'll probably see some low points. We might see some spikes over the winter. But overall, we're a little bit cautious on the outlook for the next 6 months. But then going into the second half of the year, if we think that OPEC production is going to come back, non-OPEC production is going to continue to rise, and fleet supply growth is going to come off as well, then we think that that's the point at which the tanker market starts to undergo a more sustained recovery, gathering strength into 2019. So that's our conventional tanker market update for November, and we'll speak to you again next month.